Good morning and welcome back to Almus Market Mornings. Political and economic cross currents are shaping sentiment in the US as the Republican led House moves to curb President Trump's tariffs on Canada, reflecting growing unease within his own party over the broader economic agenda ahead of elections. At the same time, unexpectedly strong January employment data has reinforced some confidence in the resilience in the labor market, with payrolls rising by the most in over a year and the unemployment rate ticking down lower, suggesting that the labor market continued to stabilize at the start of 2026. The January data reinforces the Federal Reserve's officials' inclination to keep the interest rates on hold for now, with many traders pushing out their timeline for the next rate cut to July from June. Good morning, Jairam sir. How did the dollar react to these developments?
Good morning, Reshan. Yeah, I think if you look at the dollar's reaction to yesterday's number, which was on the face of it a strong number related to expectations, coming at 1,30,000 versus 70,000, expected new jobs, and then unemployment rate dipping to 4.3% versus 4.4% expected. These are on the face of it good numbers, but the dollar's reaction has been very limited. In fact, I think it fell less than 0.75%. And if you look at particularly the yen, it's at almost same level or slightly stronger even compared to where it was before the data was released. Now, yes, the rates market has reacted, yields have gone up, but it is also to be seen in the background of these non-farm payrolls, which are released on a month-on-month basis, are subject to the benchmark revisions that are announced now and then. And the latest benchmark revision shows that job creation for for the year 2025 is revised down by 8,60,000. Of course, it was already expected to be revised down by 9,11,000. So, which means that these month-on-month numbers are not so reliable to base your expectation or assessment of the employment situation. Also, we know that last week's numbers on challenger job cuts, which is increased, and job openings, which has dropped off sharply, and also the weekly jobless claims increasing, ADP private payrolls dropping to 22,000 from 50,000. All these are indications of a weak job market, and so the non-farm payroll report will be taken, with a mixed feeling. Of course, if it does remain a trend of rising, non-farm payroll, that will be a different thing. But I think markets have had a knee-jerk reaction to the rates and a knee-jerk reaction to the dollar, and which is now coming back actually. I think we see the dollar still slightly biased lower, particularly if you look at the yen. It has been rallying for quite some time after the Takaichi's resounding election in the latest Japanese election. And we have seen that dollar yen almost touching the level where it was before the election. There's a lot of indications that foreigners are buying for Japanese bonds, which are now giving attractive yields relative to where it was 1 or 2 years back. And even the concerns about the fiscal have reduced as the Japanese government is planning to use up their reserves for spending instead of resorting to higher borrowings or increasing their debt. So there is some sort of a positivity about the dollar yen, or rather the yen, which is now continuing to make new highs against the dollar in the last 4 or 5 sessions. And that has surprised the market, which was actually looking at dollar yen to go up. So the dollar yen is actually now dragging the dollar index lower. Euro, of course, has been receiving good bits on the lower side. We are seeing the Aussie dollar, which is also supported due to higher inflation and better economic data, and support hawkish statements from the Australian Central Bank. So all these actually supporting Australian dollar, which is now at a multi-year high. Overall dollar, I would say we had a knee-jerk reaction to the numbers which are better on the face of it, but the underlying trend of the dollar is still on the downside. Also, as you also referred to, the move by the Congress to the cancel the tariff imposed on Canada is also something that to be taken note of. That means the executive power of the president is being now questioned. There is also a move to postpone the tariff on China by another year, a higher tariff on China by another year. So there is some sort of a relief on the trade between US and some other countries also, which is giving the the other currencies a boost. Canadian dollar is also trading at multi-month highs against dollar. Gold and silver, of course, they have been rangy because they already moved up quite a bit from the lows seen recently, and they are consolidating. Looking at and mostly reacting to the movements in the rates, but above sustaining above 5,100 in gold and above 90 in silver will be indicative of next leg higher for these metals, no doubt. As far as the rupee is concerned, we were again stuck in a narrower range yesterday, but underlying demand seems to be surfacing now and then. Therefore, there is no downward traction for the dollar rupee, although it is also well capped at 90.70, 75 levels. We also heartening to note that the FI numbers have been positive for quite a few days in this month, and although they are not very big numbers, overall inflow being around $2 to $2.2 billion, but the outflows seem to have considerably come off, and that's a positive for the rupee. And with the dollar abroad remaining negative, rupee gets some support. But for it to make any headway, we need larger flows to be coming into the market, and that is something that we are still looking out for. Till then, 90-20 and 90-80 range for the dollar rupee should hold. Now, attention for turns to tomorrow's CPI number from US, because that is even more important than the non-farm payroll, because most of the Fed members are still holding on to a cautious stance on the rates, and they feel that any cut in rates would reignite inflation. Therefore, the number will be closely watched. But I have a sense that if you look at the retail sales data that shows consumption is somewhat coming off, you might well have a situation of even inflation coming down with a lower demand. So that is current assessment, but let's see how the number comes out tomorrow actually. And that's a crucial number as we start to reassess how the Fed will react in their next meeting in March. Thank you.
Thank you, Jairam. So, and just to summarize, the non-farm payroll data came up to 133,000 and the unemployment trickled down to 4.3%. But the dollar's reaction was very limited and the yen stayed the same and a little stronger even. But the dollar still remains biased on the downside. But interestingly, the foreigners are buying Japanese bonds as it is giving attractive yields, and even the fiscal problems have come to a standstill. So the dollar yen stays positive and it's dragging the dollar index lower. Interestingly, the Aussie dollar is at a multi-year high due to the strong economic data received in Australia, and also the Reserve Bank of Australia staying a little hawkish. The executive power of Trump seems to be questioned as there seems to be some relief on the tariff area when it comes to Canada and China as well. And when it comes to the dollar rupee, we traded in a narrow range as it is well capped at 90.70/75 levels. And not very big, but FI numbers have been positive recently. And with the dollar weakening globally, we could see some rupee appreciation on the lower side. But the attention turns to tomorrow's US CPI print, as most Fed members are sticking to their cautious stance as they closely want to watch the inflation numbers before making any judgments with respect to the rate cuts. Thank you all so much for listening, and we'll catch up tomorrow with a fresh round of updates.